Hi everyone and welcome to the channel. In this video, we are going to talk about 10 reasonably safe alternative investments. So, before starting this video, please click I like it and subscribe to our channel for future updates. 10. Art. Fine art can be a good investment because, historically, the price fluctuations in the art market don't reflect the ups and downs of traditional stock and bonds. During the second half of the 20th century, the value of art, based on the May Moses Fine Art Index, steadily increased at an average of 10.5% annually. For example, fine art sales boomed during the late 1980s due to a surge in investment from Japanese investors, and again in the mid-2000s. The market has experienced a serious slump in the 2 years following, as well. But buyers can enter the market with much smaller amounts, closer to $500 or $1,000, if they are willing to take a gamble on smaller, undiscovered artists, or on less expensive media like photography and lithography. 9. Wine. Wine should be stored between 55 and 58 degrees Fahrenheit and at 60 to 75% relative humidity. Investors in fine wines can expect to make a steady return between 6 and 15% annually over the long term. Prices of certain vintages, and of fine wines in general, fluctuate from year to year. Wine connoisseurs and collectors are notoriously picky, so investors need to stay on top of things like which vintages will make good investments. There are also services, like wineprices.com, that track wine prices both individually and as aggregates. Even with some of the most expensive wines, you'll have to invest in large quantities to make a sizable return. And the wine must be stored in a temperature-controlled environment to keep it in optimal condition. 8. Coins. There are two types of coins to consider when buying coinage for investment purposes. Bullion coins are minted by national governments, usually in gold. Examples include the American Gold Eagle, the South African Krugerrand and the Australian Nugget. These coins are not collectible, because they don't derive their value from their scarcity. In late 2010 and early 2011, high performance in the per-ounce price of gold made bullion a reasonably safe investment. The second type of coins used for investments are collectible or numismatic coins. Popular collectible coins include Morgan dollars, Walking Liberty half dollars and certain Buffalo nickels. Many factors influence how valuable a particular coin might be, including condition, which mint mark it carries, and the year of issue. Certain years of coins had fewer mintings, making them more rare and valuable. With any investment coins, find a dealer with a good reputation and inspect the coins carefully before making a purchase, as there are always forgeries circulating. 7. Commodities. Commodities include resources like crops and livestock, fossil fuels such as oil and coal, and precious metals like copper and gold. And the commodities market is one of the most volatile, since unpredictable natural disasters and world events have a direct impact on prices. Take crops, for example. 6. Private equity. Private equity is investing in a company that does not issue public stock. For this reason, high net worth individuals and venture capital firms have usually been far more active in private equity than small investors. Often, the investors have a hands-on role in shaping the management strategy of the growing company. Individual investors have a few options for investing in private equity, but one relatively safe option is to work with a private equity firm to join a pool of investors. There are good reasons to put a portion of an investment portfolio in private equity. 5. Hedge funds. Hedge fund managers can invest in stocks, commodities, derivatives, futures, options and all types of financial instruments. This broad leeway often brings positive returns. In 2010, hedge funds around the world climbed while many stock markets fell or made modest gains. Those who can afford to invest in hedge funds should be cautious. 4. Managed futures. Managed futures funds invest in options in the commodities, currency and interest rate markets. Similar to hedge funds, managed futures funds are run by fund managers who pool investors' money and invest it in various financial instruments. However, managed futures are more regulated than hedge funds. A future is a contract to buy a certain amount of a commodity, stock or even currency at a set price at a set date. 3. Venture capital. A specific type of private equity, venture capital focuses on startup businesses that are at an extremely early stage in their business development. Venture capital firms provide startup money for these companies and see a return when the company issues stock, or when another company purchases it. Because venture capital firms invest at these companies in such an early stage, their investments are quite risky. On the downside, Most venture capital funds require a high minimum investment and a net worth of around $1 million for individual investors. 2. Financial derivatives. That definition might seem vague, but only because derivatives are a very broad category of security. In a futures contract, the investor agrees to buy an asset at a given price on a certain date. An option is similar, only the purchase is optional. 1. Real estate. Real estate investment groups contribute money to companies that purchases large properties like condos developments. Historically, real estate has been a very popular alternative investment. Of course, the 2008 crash in the US real estate market made many nervous about investing in real estate. But with prices still extremely low, real estate can be a good investment opportunity. Thanks for watching.